We're going to talk about how the Fed officials are coming out and warning about a stock market crash in 2025. Are they right? Are they wrong? Also, we're going to be talking about how liquidity, global liquidity, could be drying up. And what does that mean for stock markets, housing market, gold prices, Bitcoin, etc.? So let's dive right into it, guys, and go to Market Watch. And this is where the Fed official delivers blunt warning on the stock market, which then the stock market ignores. But what they do, I think, interestingly, in this article is they kind of take us back to Alan Greenspan, 1996, dot-com bubble. Now, for those of you who are a little younger in the audience, you probably don't really recognize the reference right off the bat. But for you old timers that are watching right now, you know exactly what I'm talking about. And they reference the irrational exuberance speech from Alan Greenspan back in the late 90s. Let's check this out. Federal Reserve Governor Lisa Cook on Monday gave one of the bluntest warnings an official at the central bank has ever delivered on the stock market. Valuations are elevated in a number of asset classes, including equity. I mean, what's really shocking about this is that this is seen as blunt. Like she's just stating reality. Like even the bulls on CNBC, you know, the jizz in your pants guys, like Jim Cramer, even they would admit that valuations are high. I mean, there's no debating that. Now they might go a lot higher, or the prices might go a lot higher, but no one's going to come out and say that valuations are low or that housing prices are cheap. I mean, come on. Valuation, again, here's her quote: valuations are elevated in a number of asset classes, and that is considered as taboo, or that is considered fringe for a Fed governor, when in reality, I mean, she's calling a spade, including equity and corporate debt markets, where estimated risk premia are near the bottom of the historic distributions. So corporate debt, so basically the spreads, everything is showing that it's risk on, I guess you could say. So suggested that markets may be priced to perfection, therefore susceptible to large declines, which would result from bad economic news or change in investor sentiment. So then Jerome Powell, as we know, has rarely been so blunt, although he has come out not necessarily about the stock market, but remember, he admitted that the unemployment numbers, let's say, had a lot of wiggle room in them. And he acknowledged a couple months ago that it is true that it was, even he said it was concerning how the revisions had been downwardly revised to the degree to which they had. Remember when that came out, 818,000 jobs downwardly revised? So even the people at the Fed, including Jerome Powell himself, were coming out and saying, okay, this is, maybe we need to take these unemployment numbers with a grain of salt, or maybe there's something wrong here with the methodology. So I get that would be blunt, right? But maybe it's not concerning the S&P 500 specifically, or corporate debt or something like that. So then they go on to say, unlike Greenspan remarks, which immediately affected the stock market, Cook's remarks were largely ignored. Yeah, I mean, look, I think it's not that she's a no-name, but most people don't know who Lisa Cook is. I didn't even see this on any other news outlets other than Market Watch. If Jerome Powell would have come out and said that, I think that definitely would have moved the market. So I think they're kind of a little bit of apples to oranges here. Now, one reason why we might see these corporate debt spreads at very low levels, which would indicate risk on, which would indicate, you know, you combine that with the stock market being close to all-time highs, and I think that's kind of what she's highlighting here. This, like the unemployment rate, is typically what you see prior to a recession or a stock market decline. But, you know, this can go on for a long, long time. Like we could see these spreads compress even further, or we could see them at the same level throughout 2025. You just know timing these things very, very difficult. That's why I always tell people it's almost impossible to know the price direction of something, right? Like is housing going to go up or down in price? I don't know. The only thing I can tell you right now definitively is whether it's cheap or whether it's expensive based on its historical price adjusted for inflation. And obviously right now, housing isn't, as an example, is extremely expensive. Now, it may go up over 2025. I don't know. That's the unknowable part. But what we do know with 100% certainty is it is extremely expensive. So I think what Lisa is talking about is when you take all of these components, all of these factors, look at all of these asset prices, she's saying we're probably a lot closer to a top than we are to a bottom. And what that means is throughout 2025, you could see significant declines in these assets, such as the S&P 500. Let's get back to the article. Economist Robert Shiller's cyclically adjusted price to equity ratio around 37, which is near the highest level since the dot-com bubble burst. The CAPE ratio, as it's widely known, measures the price of the S&P 500 divided by average corporate earnings over the previous decade. By taking such a long view, its proponents argue that it smooths out cyclical variations and gives a better view of where valuations stand versus history. At the same time, it's not seen as very useful for timing market tops or bottoms. Yeah, again, we're not saying here that today marks the top or something like that. That is totally unknowable. I mean, Stan Druckenmiller doesn't know that. Warren Buffett doesn't know that. Nobody does. The only thing you can know is definitively, again, that the cyclically adjusted PE ratio is around 37. And we know without beyond a shadow of a doubt that 37 is the exact same level that we saw prior to the dot-com bust. So then you step back and you say, okay, well, what conclusions can I draw from that? Can I draw a conclusion that there's a 100% chance that the stock market goes down big in 2025? No, absolutely not. But I can conclude that we're a lot closer to a top than we are to a bottom. And you guys, I say this on my channel all the time. In fact, we talked about this at the retreat that I did over last week here, the Rebel Capitalist retreat here in Medellin. There's three things that all great investors have. Risk management, they have an edge. And finally, they make asymmetric bets, meaning there's much more upside than downside. So right now, sure, you can go all in with the S&P 500. Absolutely. Absolutely. And you may make some money, but you just have to ask yourself, when you take all of these factors and then you use them in your analysis, you say, what's my upside? What's my downside? And downside, I don't know, 40%, 50%. Upside over the next year, 10, 12. So even if you do get that 8, 10, 12% return, is it worthwhile? I don't know. That's up to you to decide. But what I can tell you is that's not the type of asymmetry you want. Getting back to it. And let's point this out. So the bulls will say, well, if you can't time it, then we could have another 20% up year. Absolutely. Absolutely. And to that point right here, Greenspan wasn't wrong, but he was 4 years early on the call. So can the stock market, the S&P 500, go up by 20% every single year for the next 4 years to the point where maybe 37, as far as this cyclically adjusted price to earnings ratio, maybe that was, or maybe it is the same as .com. But does that mean that we can't get to 50 or 80, 100? In fact, who was I listening to the other day? I was listening to a podcast where they talked about Japan. And I think Japan, prior to their crash, so this would have been, call it 1989, they were right using the same metric or a similar metric. They were right around 80. So could the United States get up to 80? Absolutely. It could get up to 100. Who knows? The market can remain irrational longer than you can remain solvent. But that's not, if we're setting up a portfolio, that's not the question we're trying to answer. So let's shoot over to Lance Roberts. I really want to give him a shout out. I know he's on with Adam Taggart every single Saturday on Adam's podcast, Thoughtful Money. Lance was pointing out on a prior podcast with Adam about something called the January effect. And I think it's applicable to a certain degree to December as well. And basically what this is if January, like the first 5 days of trading in January, are positive, usually that means that the rest of the year is going to end positive. Or if it's down, then that usually means the rest of the year. And it's like a 70, 80% correlation. So let's go down, let's read about this, and then let's just use this as a data point along with what Lisa is saying and kind of pointing out the obvious here, that we're statistically way overvalued and therefore probably the opposite type of asymmetry you would want. Lance says, last week we discussed how it seemed as if Santa arrived on Christmas Eve, pushing stocks or markets back above the important 50-day moving average. However, by the end of the year, it seems investors were naughty Ooh, lump of coal. There was no way to sugarcoat market's poor performance. While December started with a bang, it ended with a whimper. So that not bode well statistically for 2025. But there isn't as strong a correlation with December as there is in the first few days of January. And I think he gets into that later on into the article here. Let's see. Since 1950, when all three January indicators, so that'd be Santa Claus rally, probably in December, first 5 days of January, and a January barometer, not sure what that is, are up. The S&P 500 was up for the entire year 90.6% of the time. Wow. Okay. So obviously a significant correlation. I mean, I know the Santa rally is December. The January barometer holds the key for the year. Historically, a positive January has been bullish sign for stocks. Oh, yeah. Okay. So I think what this is, guys, Santa Claus rally, December, FFD, first 5 days of January, and then the full January barometer would be the entire month. So if you have that Santa Claus rally, if the first 5 days of January are up, and if the first month, so January, is up in total for the entire 30 days, if all three of those are positive, then there's a 90% chance, or if looking back in the rearview mirror, that you would have an up year for the stock market with an average gain of 17.7%. Now, unfortunately, we got the lump of coal, as Lance points out. So we did not get the Santa Claus rally. Now, I'm going to have to look at the S&P 500 real quick here to see if we got the first 5 days in January. More on that in a moment. But he says the January barometer holds the key for the year. Historically, a positive January has been a bullish sign for stocks. The chart below highlights that the popular Wall Street maxim has stood the test of time. Since 1950, S&P 500 has posted an average annual return of 16.8 during years, included a positive January. Furthermore, index generated positive returns 89% of those years. In contrast, when the index traded lower in January, so I think this is just that for the month of January, excluding the first days and excluding the Santa Claus rally, the annual returns dropped to negative 1.7. Okay. Now, before we go into these other charts, let's look at what the S&P 500 has done this year. Let's just go to CNBC. That'll be easy. Here we go. S&P 500. Let's just look at the last 5 days. So we've got starting right here on the first or the second, so we're, as of right now, we are, it's about flat. Okay, so I'd have to ask Lance what that means. So right here, the first trading day, we're right around, call it 59.26. And then the close of the fifth, although I'd have to see if that was, let's see, second. So the 5 trading days, so that might include today. So yeah, we'll probably be up. So we didn't get the Santa Claus rally, but we'll probably be up for the first 5 days. So we'll have to see how it plays out for the rest of the month. Circle back, circle back, and then determine if there's some sort of significance there, statistical significance, that would change the probabilities for 2025 as far as S&P 500. Okay, now let's get back to it. However, 2025 will be another banner year. He asked the question. Maybe, but the market certainly faces headwinds. And this is Lance Roberts talking. From elevated earnings expectations to valuations, our best guess is that while the year will likely see a continuation of bull market cycle, it will be punctuated by increased bouts of volatility that will weigh on investor sentiment. Another thing that he said is this analysis is completely excluding a recession. If you have a recession, I've heard him say many times, all bets are off. So obviously, with what we've seen in interest rates and the curves and everything we talk about on this channel, you have to determine for your own portfolio what you think the probability factor, looking at how high valuations are right now, and then at the end of January, looking at how the entire month played out. Now let's move on to liquidity. Reserves, we'll talk about bank reserves at the Fed, sink below 3 trillion for the first time since 2020. That's a big deal. Absolutely it is. But for other reasons. It's not really the reasons that the market points out. It's for, psychological reasons. It doesn't have much to do with the plumbing. And we'll talk about that in a moment, because this actually goes back to where we were talking about the probability of a stock market crash in 2025. Now, I think that's a high probability, not 100%, But a lot of people are coming out and saying that this is a foregone conclusion because of liquidity, liquidity, liquidity. Now, although I agree with them on their conclusion, I disagree with them on what the catalyst would be. I don't think the Fed's balance sheet has anything to do with the stock market other than just psychology. Well, let's go over this. Let's look at the data. And I want to also couple this with reverse repo and see what's happening mechanically on the Fed's balance sheet so you can be cognizant of that. And then we can step back and look at what has happened in history with the Fed's balance sheet and the S&P 500 to see if there's a correlation, and then include that in our analysis of what we think will happen with the S&P 500 in 2025. Okay, so key talking points. The $326 billion drop in the week of January 1st was the biggest since 2022. Wow, I didn't know that. Officials have been shrinking the balance sheet since June of 2022, which means they've been doing quantitative tightening. The U.S. banking system's reserves, a key factor for the Federal Reserve's decision to keep shrinking the balance sheet, tumbled below $3 trillion to the lowest level since 2020. Bank reserves fell by about $326 billion in 1 week, just this week, January 1st, to $289 trillion, according to the Fed data released on Thursday. That's the largest weekly slide in over 2.5 years. The decline comes from year-end dynamics, forcing banks to pair balance sheet intensive activities like repurchase agreement. Okay, I mean, come on now. They're sitting there saying it's a result of this year-end activity. Okay, well, then why is this the biggest decline since 2022? Why didn't we see just as big a decline in 2023? Okay, but moving on here. That means cash, and here's where they completely fail. That means cash is directed to places like the central bank's overnight repo facility, draining liquidity from other liabilities on the Fed's ledger. Okay, they're just, you can tell the person that wrote this really didn't understand. They didn't understand completely what they're talking about because they don't explain it very well, because they're making it far more complicated than it needs to be. Look, the Fed's balance sheet, I can just do this on my, we'll just do a quick little faux whiteboard video. The Fed's balance sheet will do T, we got assets on the left, liabilities on the right. It's basically broken down into three main components. All right. So we've got the banks. We'll say, I just put banks right here. We'll say the bank's accounts at the Fed. So it's just like your checking account. How you guys have a checking account with Wells Fargo or Chase or B of A, whatever. That's a liability on their balance sheet. That's an asset on your balance sheet. And so the banks, JP Morgan or whoever, they have an account with the Fed, just like you have a checking account with the banks. And that is a liability of the Fed. So if they have money in this account, that is called a reserve of the bank, or bank reserve, right? So that's one major component of the Fed's balance sheet, the liability side, which they're referencing. Okay, what is the other, another major component? Well, you guys know that would be reverse repo. And then, of course, we've got the TGA, which is the Treasury General Account. So if you look at it, this is, I mean, there's a little bit more on there, but this is basically the Fed's balance sheet. So what happens is when the cash, we'll call it, goes from the TGA, let's say Janet Yellen spends that into the real economy, that means bank reserves go into the reserve accounts. I just call all the cash bank. Let's call it cash. That means the cash from the TGA goes from the TGA into bank reserves, or the accounts of these banks. Okay, so the Fed's balance sheet doesn't change in size. It just goes from one account to another. Just like if you and I, let's say, both had accounts at Wells Fargo, and I transferred $1,000 from my account to your account. Okay, well, Wells Fargo would transfer that, but it wouldn't impact the size of their balance sheet, right? Because it's still a $1,000 liability of Wells Fargo. So if Janet Yellen spends, let's say, $1 billion into the real economy, that just means that there's $1 billion that goes from the TGA into the reserve accounts. Put 1B here. That just means there's $1 billion that goes from the TGA into the reserve accounts, but the Fed, the size of the Fed's balance sheet, the liabilities, they don't change, right? And then it's the exact same thing with reverse repo. If let's say the money market funds that have $1 billion in reverse repo, they're not getting as high an interest rate as they would in treasuries. So let's say they take the money out, they buy treasuries, let's say $1 billion. What happens? The exact same thing. There's $1 billion that goes from reverse repo into the reserve accounts for the banks, and the Fed's balance sheet doesn't change. It's just that the $1 billion switches accounts. right? When people are talking about liquidity and a lot of the quote unquote experts on FinTwit, they're really just looking at these bank reserves, and that in their mind equals liquidity. So if there's bank reserves going from the reserve accounts of the banks going back into the TGA or down into reverse repo, they think that that's taking liquidity out of the system. And then if the reverse repo, the cash goes out of there, the TGA, they consider that being liquidity back into the system, because then those are going into the reserve accounts of the banks. So now mechanically, that is true. That is absolutely the way it works. But in practice, does that increase liquidity? In my view, no chance. Why? Because this assumes the banks need bank reserves to lend. It assumes they need bank reserves to create credit. It assumes they need bank reserves to create liquidity, right? Because at the end of the day, the Fed doesn't produce any liquidity in the real economy. It's the banks. That's their transfer mechanism, if you will. And by adding bank reserves in there, it doesn't give them any more balance sheet capacity to increase their loan. Now, people think that it does, but in my view, that's because they really haven't done enough research, especially prior to the GFC. Because the idea is that, oh my gosh, if there's all this liquidity going into the bank reserves, then that means that the stock market is likely going to go higher. Because everyone knows that when the Fed creates bank reserves, or does QE, that this means that the stock market's going to go higher because all of that liquidity is going to go into the stock market. And again, this is, in my view, completely wrong. And I'm going to explain why. So therefore, since I don't think QE makes the stock market go up, I don't think that QT, or the Fed reducing the size of their balance sheet, would make the stock market go down. So when we look at this headline, reserves at Fed sink below 3 trillion to lowest since 2020, although a lot of people out there on FinTwit would think this is a big deal, in my view, it is a big fat nothing burger. Let me show you why. So I showed you the mechanics there, but now let's look at how historically this has worked in practice. This is a chart of the Fed's balance sheet, and you can see in 2022 we peaked out at almost 9 trillion, and they have been doing a lot of QT since that time, all the way down to 6.8, which is obviously still extremely high, but it's gone straight down. So if it was true that quote unquote liquidity, or QE, or the Fed increasing the amount of bank reserves in the system, increased the stock market because that gave the banks more balance sheet capacity to lend into the financial economy, then we should see, since 2022, the stock market absolutely plummet. What has happened? Well, let's just focus on 2022, or let's just focus on this chart going back to 22, just a short-term chart here. And we can see that the stock market is way higher now than when they started. So how is that possible? What most of the people like to do that focus on the Fed's balance sheet for liquidity is they really cherry pick the data. Like they'll sit there and they'll look at the Fed's balance sheet, like from here to right here, and they'll say, oh, look at how much the stock market went up. But then they'll ignore the Fed's balance sheet from here to here when the stock market also went up. And then they'll ignore it here. So they just focus on the areas that have a correlation. And when there's an inverse correlation, they just kind of sweep that under the rug, and they're like, oh, yeah, well, global liquidity has got, they'll kind of just move the goalposts here. And let me tell you why I think that's historically inaccurate. This is a chart. Oh, this just shows you the reverse repo, how that's being drained at the exact same time that the bank reserves are going down, which for the people who think the Fed's balance sheet is all about liquidity would really get them up in a tizzy. They'd say, oh my gosh, this is really bad. This is a double whammy for a lack of liquidity, and the Fed's going to have to step in and do QE ASAP, or else the banks are going to run out of money. Let's do this. Let's look at a Fed chart of bank reserves specifically. And this is what I wanted you guys to see. So let's just look at 1980, 43 billion. And prior to QE, basically the exact same. There was no difference in bank reserves. They didn't really go up or down, pretty much flat. Right? But remember, the argument is that the amount of bank reserves adds liquidity to the banking system, and they take this liquidity and then they inject it into the financial markets, and then that's why they're going up. And again, if you want to get specific in the S&P 500 and look for correlations, you shouldn't be looking at the Fed's balance sheet. You should strictly be looking at bank reserves. But we'll save that for another video. So my point here is that there was no movement in the amount of bank reserves from 80 to, call it, 2007. All right. Now let's look at the S&P 500. Now I want you to look at, we'll just call it from, you can look from 1980. It was roughly 100. And then at the end of 1980s, it was 358. So you can see how much of an increase this was, right? And it had even more of an increase because we started right around, call it 300 in 1990. And by the end of the decade, we were up about 1,500. So 5 times it went up in the 1990s. Well, we compare that to the period of QE, and we start right here. Let's just say at 800. And then prior to the cerveza sickness, because we're comparing the decade of QE to the decade or a decade of non-QE, the 1990s. And we go from 800 roughly up to, call it 3,000. Okay, so if you kind of do the quick back of the napkin math, you see that in percentage terms, the stock market, S&P 500, actually went up more in the 1990s than it did in the decade of QE. Well, if QE makes the stock market go higher, how is that possible? How did the stock market go up in the 1990s? Because there was no QE back then. The Fed's balance sheet, the amount of bank reserves were the exact same. They didn't change at all. So you see my point. It's if the market went up by a greater degree when we had no QE than when we had QE, then you can't sit there and say definitively that QE made the stock market go up. In fact, I think there's a better argument that QE actually reduced or was a sedative, that the stock market would have been higher without QE. Maybe. I think that's a great argument because look, if we take this decade to that decade, the stock market went up less with QE than without QE. So why are we not talking about how QE makes the stock market go down? Or why are we not talking about how QE makes the stock market lower than it otherwise would be? I think that's just as good of an argument, right? So you get my point that if bank reserves really mattered, you'd see a much stronger relation with QE when we had no QE where the stock market went up even more. So going back to this article, reserves at the Fed sink below 3 trillion. Should you pay attention to this? Should you pay attention to reverse repo? Yeah, you should. You absolutely should. But from a standpoint of psychology, not a standpoint of mechanics. Because I can assure you that the amount of bank reserves in the system have no relevance whatsoever to the amount of liquidity because the banks create the liquidity and they don't need bank reserve. And if you don't believe me, just look at history prior to QE, prior to 2007. My point here is when you're setting up a portfolio, it's not about what you think. Like George Gammon knows that mechanically this doesn't make a difference, but that doesn't matter when I'm setting up a portfolio. When I'm doing a whiteboard video, that matters when I'm trying to explain it. But when I'm setting up a portfolio, it doesn't matter because the market thinks that QE does, right? So it's not about what George Gammon thinks. It's not about what you think. It's about what the market. So it's a big edge for you to understand. Mechanically, it might not move the needle, but psychologically, it's definitely a component into how much capital goes into the S&P 500. Therefore, you've got to use that in your analysis of probabilities that we do have a significant stock market decline, a large decline in the S&P 500 and in asset prices in 2025. Wanted to get her direct quote there. Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.